was a very scary time for me. I guess made things a lot easier for me. I said to myself, look, if I blow $15,000, is it going to destroy my life? No, it's not. It's going to hurt, but it's not going to destroy my life. But if what I believe is going to occur, if it pays off, this could change my life forever. And that's sort of why I thought, okay, just got to stick with it. And that, I guess that made me feel a lot better. Okay. So the takeaway here is that if you have an investment in shares, you are effectively an owner of a company.
Just a quick pause before we get into this. Trading can be intense, and staying mindful during your session matters so much. That's why I created and am sharing a free 3-part audio experience that's helped me deeply. 1 for starting your day with calm intention, 1 to stay centered while you trade, and 1 to wind down with grace when it's time to stop. These tracks are yours. Just click the link in the description. Hey, welcome back. Here at the Market Mamas podcast, I cover a wide range of topics from the intricacies of day trading to mindset mastery and psychological growth, with the goal of the conversations being next level growth for all of us. My name is Becky, and I'm a US-based futures day trader from the Pacific Northwest. My trading experience includes trading stocks, options, crypto, and futures, with both trading a personal account as well as with prop funding companies. Over time, I found that I most enjoy the fast-paced world of intraday futures trading, so that is my primary day trading focus now. Thank you for joining me on the Market Mamas podcast today. Hello, and welcome back to the Market Mamas podcast. So I am Becky, the host, and I am very happy to have with me a guest today from Australia named Peter, who has had a long history in the markets as well as in business. And so he is here today to provide us some excellent tips on lessons that he has learned through his career that we all can take away some gems today. So Peter, thank you so much for being with me today.
Becky, that's been my pleasure. So hello, everybody. My name is Peter Solanikow, or Solanikow is the original way of pronouncing it. I am actually based in Melbourne, Australia. I have been educated in business and finance with a stockbroker's specialization. So this is something that I have been interested in and pursuing for quite a while. However, it hasn't been my main source of income. It was always there as a form of additional income, which I had always hoped that it would make me rich. But ultimately, from the time when I completed university, I started my first business, which was a tutoring agency. It's just something that I've always wanted to do. I've always wanted to run my own business. I always have. I've never worked full time. But I have, in terms of the stock market, it's always been, particularly when I was younger, it was something that was close to me. I did do work experience at stockbroking firms because, again, that was something that I was supposed to be, according to my parents, was a stockbroker. Look, I had no problems with that myself. I enjoyed trading. It had, good status, good prestige. It wasn't exactly a hard labor job. Seemed interesting, seemed fascinating. Could make lots of money, not exactly hard labor. What I found concerning, or what I found to be a little bit of a problem, was that this had to be done full time. And that meant waking up in the morning 5 days a week for many, many weeks of the year. And that's something that I really didn't feel comfortable with. So as I was approaching the end of my university years, I was thinking, oh my goodness, what am I going to do? How am I going to extend my studies? I was always making things up. So I did additional subjects at university to prolong that. Then I did the stockbroker's qualification after that. And then finally I started a business. However, the skills that I did learn, I applied them for myself. And the way that I approached things was having my business, which would allow me, again, this was a tutoring agency. I tutored accounting, economics, business management. I employed about 60 tutors over time. So it was quite a good business. That was my main source of income. And then the income which I got from that business, I would then invest in the share market, because interest, putting it in the bank, doesn't really pay much. And this just seemed like a good idea, where you probably heard the saying, make the money work for you. So rather than having this money just sitting in the bank, not doing much, I thought, okay, well, I've got this income and then I'll invest in the share market. what I did was, but again, we're not talking big amounts. I was only quite young. So when you're young, you're starting in life, and I bought myself, then there's the vehicle. So you bought yourself a car, and, you just buy things yourself. Your parents stop subsidizing you as much. And then you have to, you buy your own things. So clearly money was still an issue. So I didn't have tens of thousands or hundreds of thousands of dollars. I had thousands of dollars. So what I did then was, I did a quick calculation. I'm thinking, okay, I've only got a few $1,000, say $5,000 or so. If I invest it now on a blue chip company, once again, we're talking Australia, but in the US or Canada or wherever your audience may be, whether it's even in England, you will have your speculative stocks, your mining, and then you've got your blue chip. These are your stable, your Microsofts and Apples and so forth, and Nestle's and so forth. The good thing about those stocks is they are stable. They're solid companies, they pay dividends and so forth, but they are what I then refer to as, well, quite boring. If you can make 5%, 7%, great. But when you've only got $5,000 or $7,000 and you do the maths, and then 5% or 7% on that. And in those days, I'm pretty old now, but in those days, this is pre-internet. So you had to call up a broker, and the brokerage rates would have been $50 a trade or $70, depending on which broker it is. So if you think about it this way, you've got your $5,000, and then you've got your transaction fees when you buy, when you sell. That obviously takes a little bit of a chunk. So then if I was going to invest in these blue chip shares, I thought, well, I might only make a few $100s per annum. So clearly, if you're young, you're full of energy and testosterone, and you want to be rich and have Porsches, it's not going to cut it. So what did I do? I invested in the speculative shares because I thought, look, $5,000, 10% is not going to do me, but doubling it or tripling it will. Okay. And a Microsoft won't triple. But a mining company or speculative stock will. So that's lesson number one. If you've got a small amount of money, if you take into account the transaction fees, which are now much, much smaller, as a result, it's more cost effective now. Probably you've got two options. Now, the first option is to make it worthwhile for you, you need to take a higher risk. Unfortunately, in more cases than less, I lost money because these are cheap for a reason. They're highly speculative, they're highly risky companies. Okay. So I got burnt once, I got burnt the second time, I got burnt the third time. So I thought to myself, okay, basically, like I said, lesson number one is maybe $5,000 isn't enough to invest on the share market. So then after a while, I was thinking perhaps maybe about $20,000. So if you're listening now, well, obviously you are listening, and if you do want to invest in the share market, and if you are thinking about doing so, you haven't done that, you're not quite sure how much to invest, like I said, you need to take into consideration the fact that on average, roughly per annum, your stable shares will go up 5%, 7%, something like that. There's always a risk involved. There are transaction fees, which are quite small, but still they're there when you buy, when you sell. Maybe there's tax on top of that. So you need to ask yourself, well, if you've got a small amount of money, is it worth your while? Because at least in the bank, the money's there. It's always going to be there. Whereas here, the fact is that you might be stuck for a while because the shares aren't moving anywhere. They might fall for a bit, and then if you're going to be potentially earning $300 or $400 or $500 in a year, it might not be worth your while. So then you might ask yourself, well, maybe if I just save a little bit more, like maybe 15,000 or 20,000, then that's a nicer pool of funds. So now 10% of 20,000 becomes 2,000, as opposed to 10% of 5,000 is 500 minus transaction fees. So as you can see, so that's what happened. So I got burnt a little bit. So that's lesson number one. Okay, my minimum to invest went up a little bit higher than that. Then I guess a big learning experience, or a big, I guess, situation that made a big effect on me was the approach to 2008. By 2007, I felt that there was going to be a big economic crisis. And we're talking about the global financial crisis. So I knew about that was going to happen. in about 2007. Just things were not right. When they're giving out loans to people who haven't worked for a number of generations, bad things can only happen. And then I said to myself, okay, how can I make money on a falling market? Because I know the market's going to fall. Mind you, when I did my stockbrokers course, yes, we did learn about options, but options were very abstract. I mean, I'd never traded them. I mean, I learned about them in theory, but I didn't quite know what they were about. So by 2007, in 2007, I then went back and reflected on what I learned in options, but more from a practical perspective. Because that's really the only way that you can, well, there are two ways. You can short sell, but I haven't got any experience in that, and that's actually not that easy to do for a normal person. You have to borrow shares from somewhere and so forth. It's not that simple. But I guess the more easiest way to get into a falling market is simply by buying put options. So I thought, okay, I believe the market's going to fall. The best way, or one of the really only ways to make money, is to buy some put options. So that was 2007. I was buying a few put options. I invested a few $1,000s going forward 3 months. I was buying contracts which had 3-month expirations. I blew my cash. That was a bummer. Market was kept on going up a little bit, but I was certain that the market was going to fall. So by early 2008, I started to buy again more put options. And I was buying, but this time I said, this time I will nail it. I'm going to buy December options, December ones. So this is in January, but way out of the market, because the further you go ahead of time with options is like insurance. So insurance, you're effectively insuring yourself against some kind of occurrence. In this case, I was insuring myself against a falling market. So the further ahead you insure yourself, the higher the likelihood that something will occur. So therefore, the premium is higher. However, you can compensate that by buying way out of what's called out of the market. So if if the index is at this point here, and if you buy further away you go, either up or down, the likelihood of that being a payout is going to be a lot smaller. So therefore, that insurance in that respect is going to be cheaper. So I bought the index options. They were 3,000s. I think the share market at that stage was Australian All Ordinaries was, or ASX 200. I think that was about 5 or 5.5 thousand. So it was, at least like way out. I mean, when I think about it now, it's just crazy. But it was December. So I started to buy those. Market, nothing much was happening, blah, blah, blah. And I was just so certain that I was investing more money, more money, more money. And that was getting scary, because the thing about options, the difference between options and shares is that with shares, you actually own a company. And if it's a solid company, you own a piece of a company, and you're actually owner of something that makes things, that has money in the bank and so forth. Options is, we don't really own anything. It's just just insuring yourself. So this is one of the problems with the options, is that you effectively, this is where you can lose all your money, because once they expire, in this case, if we don't get to, the 3,000 index by December, that's it, they're all gone. So I'm putting this money in slowly, 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 and it's starting to get scary, because effectively, that stage I had $15,000 I had invested in something that was worthless. But look, I nailed it. I finally did nail it. One of the things I know that your program focuses on is psychology. And yeah, and that was very scary. That was scary. I guess, look, I don't know what gambling addicts feel like, but I felt pretty bad where I had this money. I was kept on putting it in, and nothing was happening, and I was behind, and the options were the fair value of the options was falling and falling and falling. And then I'm thinking, what do I do? Do I put more money in? Because remember, now the price is getting smaller, because it's in March, April, May, June, time period is decreasing, and it's a dilemma. I've invested so much, but I paid 15 cents for these options. Now they're 3 cents. Maybe I should put them for three. So it's a real dilemma. And it was a very scary time for me. And I remember I was sweating in bed. I had sweating that eventually my bed, the mattress was yellow. sorry to disgust you, but it was sort of yellow because you just from the sweat over, it just soaked through the mattress protector, whatever. It was just scary because I had never really put so much money in on something that wasn't going my way. I was way out of the market here. The thing where I remained made things a lot easier for me. I said to myself, look, if I blow 15,000 bucks, is it going to destroy my life? No, it's not. It's going to hurt, but it's not going to destroy my life. But if what I believe is going to occur, if it pays off, this could change my life forever. And that's sort of why I thought, okay, just got to stick with it. And that, I guess that made me feel a lot better. Okay. So the takeaway here is that if you have an investment in shares, you are effectively an owner of a company, small owner of a company. Unless you really, really think that this company is going to go bankrupt, even if the market turns against you, if the shares fall a little bit and you're behind, it's not a good feeling, but at least know that, look, I have a share in a company. And it's, I guess, hopefully you've bought a fairly good company. And so, will the company fail? Probably not. If the company is fairly solid, it's just a matter of time for things to come back. If you are going to invest something that has no intrinsic value, like your cryptos, like your, warrants or options, whatever, then you need to ask yourself, well, firstly, you need to invest the amount of money that you can afford to invest. And secondly, you need to ask yourself, okay, if I do blow it, is it going to change my life? Hopefully it won't. If it's going to destroy you, then you've got a problem. That's just a bad decision. Then that's just clearly a bad decision. Then yeah, you got a problem. But if it's just going to hurt you, it's going to hurt your ego, it's going to hurt your wallet, but it won't, but if it's not going to destroy your life, maybe on the upside, you can change your life. By the end of September, I had made over $100,000 on my $15,000 investment. So it was very stressful. My bed was yellow, but I had made more money in a shorter, because once the market started to fall, they started to fall. And once these options started to gain in value, oh man, that happened really quickly. From a fair value of 0, which was devastating when you log in and you look at the fair value of your options and it says 0 and you've got 15,000 of these things that you're with 0, that hurts. But then it was 1 cent, 1.5, 3, 5, 10, 15, 30, 60, 70, 75, 95, $1.08. And then I started obviously to pull out. I started to pull out because I was so scared, because I had bought in so early on and I was so stressed out. The majority of my options I pulled out when I was about 30 cents. So I effectively, made my money back. It pretty much just made my money back, but I still had half of my options, which is a bummer, because then it really started to, once the market fell, then if you can remember, then things started to really move quickly. Look, doesn't matter. I still made over $100,000 in, well, really 2 or 3 weeks. Okay, the fact that I was holding it for 9 months, but from 0 to that. So that was a real, that was a game changer for me. I had made more money then than I had ever done, so that was fine. And then obviously I reflected on that. I thought that the share market was going to continue to fall, so I bought more put options. And then it recovered, so I blew some of that money later on. And then I reflected on my experience, and then I thought to myself, I could do this better, because buying options, being an options buyer, you always start off in a losing position, okay? Because you're paying a premium for something that has to happen. In other words, if you're out of the money, you're still paying for something which isn't something. The options writer is the one who's already get a head start. So they're like the casino who's already got that house. You know what I'm saying? That it's on their side. But by that stage, I had over $100,000 saved. I thought, I'm going to be an options writer. because that's where the money is. So I've got the experience here. I'm thinking, well, I'm always behind. When you're buying these call options or put options, you're always behind. You're always out of the money. Or if you are in the money, your premium is much, much, much higher. So you kind of, whereas these guys, they get the money straight away, and it just seems like it works in their favor. So I thought, okay, well, I'm going to be the casino now. So I then transitioned over to writing options. Now, to do that, you have to do, I'm not sure how it is in the US, but over here, the stock exchange, you have to prove to them that you're a sophisticated investor. And to do that, they give you a bit of a test. Okay, you have to read this manual, and then they actually give you a test. And then you have to get a certain amount of points for that test. And that at least tells them that you know how they work, you know what the risks are, you become a sophisticated investor, and then you become a level 4, they call it a level 4 options trader. So then you actually write the trades. And that was, that's, oh my goodness, that was scary stuff. That was bad. That was really scary. Because the thing about being an options buyer, buying your calls or put options, is that if you invest 2,000, that's all you can potentially lose. So think of it as being an owner of a car and you're insuring your car. So you pay the insurance company, say, $1,000 per year. Chances are that you won't have a car accident. That's why the insurance companies make so much money. So they, on day one, are taking your $1,000, okay? And then the only way that you're going to make money, but you're not making money here, you're actually insuring yourself against a loss. But the only way you're going to make a deal is if during that 1 year of insurance, you can have a car accident. You don't want a car accident. They don't want a car accident. So things are stacked against you having a car accident. So more often than not, a year passes, they kick $1,000, so they're really happy, and your insurance gets blown away. Okay. So that's why the insurance companies make money. You, as the insurer, tends to lose money. But the problem is that one day you're going to pay $1,000 for your vehicle insurance, and then you're going to do something stupid, and you might scrape 4 cars and then hit a bus and then bounce off and drive into someone's home. And then you'll cause $100,000 worth of damage. So that insurance company now, for your $1,000, they'll have to pay out $100,000. That's a big loss. And this is what happens when you become an options writer. If the market turns against you, your losses are unknown. And that becomes really, 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 really scary. Really scary. There are a couple of safety nets. You always have to, if the market's going against you, you have to put in, it's like a buffer. You have to sort of like put in a buffer. And that makes also things a little bit more difficult, because the stock exchange says that a buffer has to be at a certain amount, and then the broker you go for, they have an additional buffer just in case. It's called basically margin call. That's basically what it is. It's a margin call. So there are 2 types of buffers. And the problem with that is that unless you have lots and lots of money, chances are you're going to start reaching those buffers. And that means that you would then be forced to buy back some of those options, which normally you would have kept. So whilst in theory it seems that it's a good way to make money because there are so many restrictions, you would often have to buy back these options well before, just to protect against further losses than you otherwise would. So that's kind of stacked up against you. So to cut a long story short, I didn't, I made losses. Even though I was an option writer, I made losses. And the fact is that when I did make profits, they, a couple of thousand here, a couple of thousand there, but the stress, the panic that sometimes I went through, it just wasn't worth it. It just really wasn't worth it. And so I stopped trading. But I have been in business. I've been in a few businesses, and the business that I have been over the last few years has required me to invest for products. I actually export Australian souvenirs, Australian products, Australian themed products. I export them to Europe. So I got to the point that after trading, after having shares, I guess the one that broke my, the camel's back, not mine, was an oil company which I had, which seemed on paper, that's the problem. When you look at prospectuses or when you read annual reports, when you read news, they're always so glowing. They're always so fantastic. The prospects are always so good. And effectively, what you're doing, I'm talking about the highly speculative issues, you're effectively, your return or your investment is linked to the competency of the people who are running these companies. Ultimately, they get a wage, whatever happens. If they run their company down, well, they just start up another one or tag team with somebody else, whatever, and they're on the wage again. I've always considered myself to be very smart, very strategic, and so forth. And I thought, screw that. Why should I use my money and invest it in a company that's managed by somebody else when I can use that money and then manage it in a company, the business that I own? And the success or otherwise of this business is entirely dependent on me. So I now trade Australian products, t-shirts, magnets and caps, and we've got about 200 different products. So my money, unfortunately, I don't have enough money to spread around, to buy all sorts of things. So it's either the share market or so my money has been on my businesses. Before that, I started a tourism company. So as I was making money off the share market and I was slowly pulling out, I had moved from my tuition business, which unfortunately I had to shut down. My marriage had broken down that same year when I made all that money on the share market, which was 2008. My marriage fell apart. My wife took the kids, went overseas, and my life changed a lot then. I wasn't able to run my tuition agency because I was going to Europe for a few months every year just to see the kids and so forth. I got depression, so I was depressed. I was staying at home. I didn't want to go out. And, went nuts basically. And this is the time when I was trading options as well, and that did not help at all. The stress, the pressure, it was just insane. So after a while, once I got my sanity back because of medication, I wanted to go out more. I wanted to, I was effectively imprisoned at home, not because someone had imprisoned me. I just didn't want to go out. I didn't drive. I had a BMW, which I left effectively abandoned because I wasn't driving. It had all cobwebs on it and so forth. It's a pretty sad situation. But anyway, after I got back on my feet, I still had some money saved up. I wanted to go out. I wanted to do things. I felt like I just got out of jail. And so I rang a few of my friends. Let's go for a holiday. Let's go this, let's go that. But unfortunately, my friends were day jobbers. And what I have found with people who work a day job, they either don't have money to go for a holiday or they don't have time to go for a holiday or both. So I thought, screw you all. Screw you. I'm going to start a tourism business. And I'm going to have an infinite number of tourists and people I'm going to travel with. So I invested in a new BMW. I bought a new BMW. I invested in that business, and so I started to once again just make income. Then the coronavirus hit, which is not a problem for me because what that allowed me to do was to take advantage of the very bad tourism sector and actually buy a whole stack of souvenirs and, well, effectively souvenirs, which I got at a really bargain basement price. And I started to export those overseas because my tourism business was suffering. But then I had this opportunity to buy all these products, which I make money from now. So effectively, I'm now starting to rebuild up my income. And now I'm potentially ready to go back into the share market again because what I have found now after all these different learning experiences, certainly when I was trading options, shares were very, 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 very boring. When you trade options, you can make 20, 30, 40% per day in a day. You can make them. So even the speculative shares, you kind of lose interest in them. I would trade now options. I would trade options in cases where I feel that there is real market turmoil. In other words, when I can see some big swings, I would only invest a small amount in options. I don't care which way the market's going to go, whether the market's going to go up, whether the market is going to go down. It doesn't matter with options. If the market is going to go up, you buy call options. If the market's going to go down, you buy put options. Another thing that you must, if you want to make money off options, and the reason why you can potentially do that is because you can make money off an increasing market or a decreasing market. So this is the beauty of it. You must be unbiased. Okay? You can't be pessimistic. You can't be optimistic. You really have to take things as they are. As much as you might be a patriot, America's the greatest, we've got the greatest economy, blah, blah, blah. If the reality is that that's not the case and you're going to be buying call options, then you just blow it. Okay? You can't be an eternal pessimist. Oh, things are bad. Things, this is it. And then just pick and choose all the negative articles, all the negative podcasts, all the negative speaks and ignore the positives. And then you'll be buying put options. You're going to get screwed. You have to find a number of credible sources of information and then absorb that information. I'm talking about economic information here. And then come to a conclusion. Okay, is the market going to go up or down? Not which way I want the market to go, because it really doesn't matter. It's not about you. It's about what will potentially happen. And if you believe the market's going to go up, you buy call options. If you believe the market's going to go down, you buy put options. That would be another takeaway that I would find from that. If I were to be buying shares now, there's a few companies I have on my radar. These are Australian companies, but they are gold miners. I know that America has got quite a few, and I'm talking about the juniors now. Because gold and silver has gone up so much over the past, year, really, it's been going up for years. But really, the momentum has gone up so much that all the big guns that, your Newmonts, your mainstream, your core companies, they've been invested to the hill. So what then investors do, the fundamental analysts, they basically think, yeah, this has reached its level. Then they go down to the next tier. These are like the small producers. By this stage, the small producers are also quite well pumped up. So then they think, what's next? So then you go, the companies that are discovering or that have discovered already their gold, but they haven't started to develop it. So they're still a little bit behind the production, but that's still where the money's to be made. So that is where I would potentially be investing. I was about to invest when there was the trade war with Donald Trump. I was going to buy some, put options, but unfortunately, it was just too quick for me. So I'm slowly, now that I've got my finances back in order, I've got a solid income coming in. Once again, I'm wanting to make my money work for me, but I'm going to be doing it more conservatively. And I guess that's another takeaway, that trading on the market is not that simple. I know that, Becky, you were talking about Ray Dalio not long ago, and there are also many other investors out there. It just makes things so much easier if you've got a hedge fund, if you're getting regular pools of money coming in. You can constantly be in the market, even if you buy some shares or options or current, whatever it is. If it doesn't go your way, you're stuck. That's not a problem, because next week, next month, you're going to get under $50,000 or $100,000. You just invest some more, and then eventually these things will go up. But if you're a normal person who doesn't have tens of thousands of dollars coming in on a weekly basis, if you end up buying some assets, and if they haven't gone up, or if they've gone down a little bit, you kind of get stuck. And then what do? Do you pull out and make a loss? Yeah, you can do. Yeah, sure. But what if you waited another month or so? You'd make a profit, or it's just not that simple. So what I'm happy running my businesses. They are under my management. They are under my control. They allow me to make some money. And then that money, once I have enough money, a buffer, I then take that money and then I look for a potential investment. So that money, I'm a bit of a slave driver. So that money doesn't sit there. It's got to work. Okay, that's the way that I approach it now. So as much as I'd love to be a day trader, as exciting as it seems, you're trading this, it can be stressful. Sometimes you get stuck. Sometimes you can make a loss. Things don't go against you, and what do? You know what I mean? So I'm first and foremost, I'm a business consultant. I help people. I help people get into business. I help people improve their business. As a result, I have my own businesses because I do what I preach, and that should be. I would recommend that being your first way to make money. Depending how you structure your business, you can have a great lifestyle. You can go to sleep whenever you want. You can wake up. You can travel around the world as well. So it's not about trading and investing and doing that. You see the photos, laptop, coffee, palm tree. Yes, you can do that from all around the world. But I actually travel. I'm overseas for 3 months of the year, and I'm also interstate for about 3 weeks of the year as well. So I have about 4 months of holidays running businesses, and it's just that's just part of my life. So I've structured my businesses in such a way that allows me to make income and still live my life. Some people love waking up very early in the morning. Great. You can have a business where you can do that and then make money. And then rather than having that money pool in the bank, that's you might consider then investing that money. And if you make extra cash on top of that, fantastic. That's great. Obviously, once you start making the profits, then you can take more risks. Then you can set aside that particular amount of money and then potentially make even more money. And that's how the cycle begins. But ultimately, you need to start off with something. I started off with a small amount of money when I was young. I took higher risks. I got burnt, which most of the time happens. I eventually got into options. I made some money out of that, thankful, luckily, but incredibly stressful. And I'm at this stage now where I'm just looking for a little bit more stability. I'm a little bit more conservative, and I guess that's where I'm at the moment.
Thank you. That was such an interesting story of your life and how you started with options and business and how it all has kind of built together. I think all of those pursuits that you have worked through have been probably educators that have like refined you in your view of the market and the way to use options and the way to use your money and the stability that business can create and the ability to control versus the less control you have with options and the different angles of selling them versus buying them. Like, I really appreciate you kind of going down your experiences and how you have grown and pivoted and used that. It's really beautiful. I think there's a lot of traders out there that will trade and build up some funds and then diversify and start into business just as you have, because it sort of spreads out your effort and it adds different like levels of risk in what your money is doing, which I think is so smart because you like you said, you might not want to trade 5 days a week and have that be your only source of income. And to be able to take a vacation and have your business provide you stable capital returns is great. So that's very interesting to see how you have grown with all of that. Thank
Well,
you.
ultimately, this is investing. So ultimately, your product is money. So you need to have money you can't buy currencies or whatever if you don't have money. So now you need to ask yourself, well, where do I get this money from? If you're fortunate enough that you've inherited lots of money, oh, look, go for it. But all I'm saying is that if you want to do it like consistently, you do have to have a reasonable pool of money to start off with. And certainly you need to have incoming money coming in on a regular basis, because you have to assume that you're not going to have winners all the time. So you need to have something that will allow you to live while you're waiting for your assets to appreciate. Unless you've got huge amount of money, I'm talking like literally millions, then you can invest hundreds of thousands in various assets and still have a nice bundle left over just to live, just on that. And in that case, I guess it's hard unless you make some really stupid decisions. It's kind of hard to lose because you know what I mean. Like there are some like things will if you invest. I don't know, even in currencies. The thing that the currency is incredibly speculative. I wouldn't touch currencies myself because there's just no control. Like there's literally anything can happen. Like, put it this way, if I can't predict roughly what's going to happen in the next few days with what the value of a particular asset is going to be, well, it's clearly not an asset for me. because it's like gambling. Because it's like predicting what the next, what are the next two colors going to be on the roulette, red or black. I mean, no one's going to know. You just don't know. Like currencies, there are just so many factors that can influence a currency. Where as opposed to, for example, like gold shares, just gold has to go up. And that's pretty much it. Well, and the market's got to go up. But if the economy is generally strong, markets have a tendency to go up once again. And if gold goes up as well, then, or a normal, your normal mainstream company, your blue chip company, they tend to go up as the economy grows and so forth. I guess one little trick that I learned, you would probably need, I advise, or I talk to the people who are interested to listen to me. I say that if you have at least $100,000, there is something called ranking your shares. Are you familiar with that, Becky, about ranking your shares? No? Okay. What it is, you need to get a blue chip which has options attached to them. So that's usually blue chips. So what happens is you buy shares company A. Okay. You have $100,000 worth of them. And so the normal investor just buys blue chip shares company A and just holds it. Okay, you get dividends every 6 months or so. If the market goes up, they go up. You get dividends. Market goes down, they go down. Just get your dividends and eventually they go up. But there's another one. There's another, you can do it. There's a little bit of a twist. You can also write call options to them. So what happens then is, so you've got your shares and company A. Let's just say that they're $100. Okay. You can then write, if you're happy to make a 10% return on those shares, say in the next 3 months, what you then do is you then sell $110 call options. Okay.
Yeah.
And then the buyer will pay a premium for those. So then you get the money. And the risk here that you take is if your shares do go up beyond $110 within that 3 months, then you have to then give those shares, sell those for $1.10, even though it could be $1.20 on the market or so. So you kind of lose, but not really, because you've still made your 10% and you've got the premium. But the thing is, if those shares don't go up 10% after 3 months, they go up 5%, you've kept the premium, you've still got your shares, they're at $105, you bought them for $100, so you've got a 5% appreciation, you've kept the premium, and maybe you get a dividend in the meantime. If the shares fall down in value, well, you're holding shares which you would anyway. Okay, you don't get called for the option, so you keep the premium. So it's just a better way. You're effectively making money from you're utilizing your shares to become a source of income from two sources, from dividends as well as from the options. It's called like renting out your shares, basically, where effectively
Yeah.
you're kind of
We do that in the US as well. We just don't call it ranking the shares. It's just
yeah.
you have to own the company and then you can sell options against it. Yeah.
Yeah, exactly. Yeah, it's another way. Yeah, you're kind of like renting them out. You know what I mean? Where you've got them and you're making money from them. I'm just simplifying it. So that's something that I'd be really happy to do actually. In my age, but you need a bit more cash. You're minimizing your risk. You've got two sources of income, and it's quite good. So I guess that's sort of what my final aim is going to be. So. So what I've tried to do here is just to provide a wide variety of different options that are available for investors under different circumstances, different risk profiles, different markets, and hopefully, what I'm hoping is that through my stories, that your viewers will learn something about that. Maybe they will consider their situation, and then they might also consider what would be an appropriate investment position that they might have. Based on, what they think the outlook is going to be.
Yeah. Thank you so much. It sounds like you base a lot of your trading on fundamentals, like market sentiment, and the value, overvalue, undervalue, and not so much a technical trader. Is that accurate? Or
Yes, it is. That's my starting point. And then once I'm happy with a particular, I'm thinking, okay, based on that, I've then focused on that particular company. Then I guess I would use technical analysis just to get the magnifying glass out and just to find out a particular price. So I might have 2 or 3 companies like in a particular sector. So if I think that in this particular sector, I've worked out that it has a good potential. Okay. So then I take my 2 or 3 companies in that particular sector, and then I look at their price range, and then I start getting more technical. Okay. and I start putting buy orders in, and then whichever one gets nabbed, obviously, there's a risk with that because it might, go up. So I kind of use both, but my starting point would be the overall direction. Overall direction. Is it an overall positive? Is it an overall negative? And then, like I said, once it comes time to buying, then obviously you need to get a good price, because ideally, you buy low, you sell high. So clearly, I usually don't just buy a random price. I try to nail the best price possible, and that's when the technical analysis comes in. It's clearly not a guarantee, but at least I don't like guessing. I don't randomly, like even at the casino, if I go to a roulette, I just don't sit down at the table and start. I then get my little card. I then look at the last 20. I then see if there's a trend, if the ball has landed in any particular quadrant. If I don't see any particular trend, I walk away. Okay. By the way, I'm not a gambler. I hate gambling. But I'm just saying, if that was usually it's my dad goes to the casino. I'm his sort of helper. So I use his money, but I do the calculation. And I said, Dad, no, no, I wouldn't touch it, And same with you. I don't just randomly think, oh yeah, I'll buy this company. No, there's a fair bit to it. Just the way I am. I guess maybe that's why I'm a good businessman, because before I make any decision, I try to, I assess the market. I assess the price. I always try to get a better price for, whether it's labor, obviously try to keep it low, or particularly now products. I try to, the warehouse, the suppliers, I try to, nail them down a little bit. All it means is that, the lower you get, the more margin you make. And that's kind of my approach. Yeah.
Yeah, it's smart. You have to do your due diligence, like have an understanding and a plan, and then kind of dig in a little bit and make sure it's as solid as it can be. Get your best price, and then ride it to a reasonable point with the options. I mean, options are riskier, which you alluded to, because of the theta factor. I mean, if you have to be paying attention specifically to your expiration date and when you think the move might happen, because theta will take all of the investment on that. So yeah, that's some great lessons in what you said today. I really appreciate you going through that with us.
Good. Do you have any questions at all? Or?
No, I think I really just enjoyed hearing your story about how you have grown through options and business and how you make it all work and the way that you have diversified your life. It's just really great. I appreciate you sharing your story with us today.
Okay, not a problem at all. Well, thank you for giving me this opportunity. Like I said, hopefully, once this, if it does go on air, hopefully, I'll see the comments and whether people are thinking, oh, this, guy's talking good, or
yeah,
don't bring him on.
Please leave comments for us, and we can come back at Peter with any questions.
Beautiful. So yeah, so you've got my contact anyway. So I'm more than happy to come on.
Yeah.
Depending what sort of feedback you get from your viewers. Like I said, if they want to talk about business or whatever, it's that's really my specialty, to be honest. But yeah.
Well, and if you'd like to leave a contact, we'll put it in the show notes. So if people wanted to reach out directly to you to get more information, ask questions, curious about your story more, you can, give me some contact point for the audience as well, if you're up for it.
I'll do that. No worries. Okay,
Great.
I'll do that, Becky.
All right. Yeah. Thank you, everybody, for listening today. We appreciate you guys being here on the podcast and learning more about Peter's story with options and business and all the ways that we can grow in this world as entrepreneurs. So thank you, everyone, for watching. And thank you so much, Peter, for being my guest today.
Oh, that's my pleasure, Becky. Really. Thank you very much.
Yeah. Take care, everyone. Bye.